Hewlett Packard reported yesterday after hours, and it was not the best. Let's look at our software here real quick to see where HPQ is currently. And they're currently down 5.7% right now today to under $30. So here's what happened. They beat on earnings. EPS was $1.08 versus expected of $1.04, but revenue was $14.7 billion versus the $15.74 billion that was expected. That ain't good. Now, they had more profit than they did last year, but the revenue was lower. So what does that mean? Does that mean go avoid the company, go sell it? Well, a lot of people seem to be doing that. Now, I don't necessarily agree with that. So if you're new to this channel, I'm Paul. I'm a value investor. My goal is to use the short-term gyrations in stocks to find good opportunities to buy companies that I like. I do believe companies that are stagnant or dying still have value. And what will happen usually is in the market, people's perception of the company will drop so much that the stock price will drop with it. But if value is here and the price goes down, I want to buy. I use our 8-pillar process to look at the quantitative aspects of the company. Now, I'm not just some robot and only some robot. In fact, if you check out my Instagram page that's popping up right now, you'll see I have dogs, I have a fiance, I'm a decent human being. I just like looking at quantitative aspects of a business and seeing where there's a disconnect in the market. So let's use our 8-pillar process to look at Hewlett Packard, and determine what we'd pay for it using our stock analyzer tool at the end. So right here, Hewlett Packard, first things to point out. Their free cash flow for the last 5 years is $4.3 billion, and last year was $5.3. The reason I bring this up is this healthy dividend of 3.2% costs them about $1 billion per year. Guys, dividends come out of free cash flow. Don't assume just because a company's paying a dividend that they can support it. But look at this. Their dividend eats up only less than 25% of their last 5 years average free cash flow and less than 20% of last year's. So they can easily afford this dividend. My guess is, since it's not a fast-growing business, Hewlett Packard is going to spend a lot of money paying out dividends and buying back shares for its investors to give them higher earnings per share. Okay? Gross margin, not the best, 20%. They got a lot of hardware. 52-week high of 41, a low of 26, and they're currently at 29 and change. All right, so there was also reports recently that Warren Buffett, Berkshire Hathaway, had bought about $11.5 billion worth of Hewlett Packard. I don't know if that's still true or not, but it's something to look into as time goes on. It is nice to see if somebody like that has bought the company. So let's look at our 8 pillars here. Guys, this is an 8-pillar thriller, all check marks. Now, does that mean you go out and buy it? Not necessarily, but here are the things I do like. Buying back a ton of shares. A lot of times companies will buy back shares even if the stock isn't cheap. So how do we look to see the stock from a high level is cheap? Well, the 5-year PE is 7.3 versus a 22, and the 5-year price of free cash flow is 7.3 versus 22.5. So these are nice indicators to say, hey, there is some potential this is cheap. And the other thing is, guys, look at the revenue growth. In the last 5 years, they've grown $10 billion in revenue with $2 billion to net income and another $1.3 to free cash flow. That's pretty awesome. And look at their debt levels. They can pay off their debt levels to 3 years of their last 5 years of free cash flow. And look at this ROIC, this return on invested capital, 46%. Our goal is to see 9%. So far, I'm seeing a lot of great stuff. Now, they're a printer business, and a lot of people sit there, oh, print's dying. I get that. Don't get me wrong. But remember, if I showed you a company that was dying, that had profit of 54321, would it still be worth something? Of course it would. Would you pay $1 to get the next 5 years of cash flow like this? Of course you would. That's an extreme. Would you pay $100? That's the other extreme. No, of course not. So somewhere in the middle, it makes sense and doesn't make sense. That's what our goal here as value investors, to take away the public perception and go look at the company. So before we go into our analyst estimates, let me go to the income statement and just see what's going on. So there is growth, but let's go see how much of the growth was from acquisitions. So I'm going to go to the cash flow statement. Not a lot of big acquisitions. Yeah, $1 billion, $400 million, $100 million, $700 million. Those aren't huge acquisitions. You're not buying companies that have $10 billion in revenue with $1 billion. Absolutely not going to happen. All right. Even car companies sell for way less than that, for way more than that. So it's not. I'm not seeing big acquisitions in the sense of really adding big numbers to the top line revenue. Is that possible? Sure. But one of the things to do as part of the research is see what acquisitions these were, because we want to make sure that they were using cash instead of stock if the stock was cheap. And two, see if it's making the business more diverse. So let's also look at the balance sheet here. Cash on hand, $23.5 billion. Total debt, 41. So they have almost as much cash on hand. They have to pay off over half of their total debt. That's pretty impressive, guys. So I'm really liking the balance sheet here a lot. So what's the problem here? I don't know. Let's go see what the analysts are saying. So a new part of our website here is we've added Analyst Estimates. Now remember, I want you guys to remember on this one. If you belong to our software and you pay the less than 1 cup of coffee a day to have all of this amazing software that'll change your life, there are 20 analysts reporting on HPQ this year. Guys, there are probably 2,000 analysts who follow HPQ. This is part of our data feed. So every website will have different ones. What I recommend you do is go look at our data feed and go compare it to other sites to see what other analysts are saying. But right now on earnings per share, they're still seeing growth in earnings per share over the next 5 years. Okay, what about revenue? Not so much. They basically have it to be from 66.25 to 64. So declining revenue. All right, so every investment is the present value of all future cash flow. But we don't know the future, right? All we can do is make assumptions about the future. Hell, I can't even tell you what's going to happen a week from now. But my goal as a value investor is to make conservative assumptions about a company and then see what pops out as my value for the company. That is why we created the stock analyzer tool. This was specifically done to give people guidance on if they should do more research or not in the company. Okay, so what I recommend you doing, if you belong to our software, put your own assumptions in or watch my assumptions. If you don't belong to our software, please keep focused on this because this is the most important and popular part of our software. Please rewatch this part as many times as you need to understand better. I'm going to go thoroughly per line to tell you what I'm thinking as I do things. All right, so first things first. 10-year analysis. You can do 1 to 20. I picked 10 years, okay? Maybe you want to sit there and look at 5 years or 15 years. I have no idea. I always pick 10 because I really would be surprised if HP was not around in 10 years. So the first things first, 10 years of rev growth, negative 6%. I'm ignoring that. I think they sold off some major divisions there. Last 5 years, 4.2. Last year, 7.2. Now, analysts are not expecting good numbers from them over the next 5 or 10 years. So on the low side, I'm going to be really, really conservative. I'm going to call it negative 2% a year. That means over the next 10 years, they're going to fall over 20% in revenue. That's a big drop. Revenue growth, middle side, 0, high side, 2%. The reason I put in 2%, we still do have inflation, and inflation will drive up revenue. It'll also drive up costs, but it's easy to pass those costs on to customers if everybody's aware of inflation, things like that. All right, profit margin. Not big stuff here. Now on profit margin, I'm actually going to ignore the 10-year number again here. I'm going to focus on 5 and 1-year numbers. So I'm going to go 5, 7, and 9. Free cash flow numbers, pretty consistent across the board. I'm going to do 6, 7, and 8. PE and price to free cash flow. Guys, these are the multiples of where they'll be in 10 years. With these kind of growth numbers, you got to be very, very low. I'm going to go 8, 10, 8, 10, and 12. Now, why did I pick 8, 10, and 12? Guys, on a dying company, you need to make your money by buying back shares and getting dividends. So I want to pay as little as possible for earnings and free cash flow, especially if it's dying. Now, if it happens to grow just a little bit, it's still worth something, but this growth of 2% isn't some insane amount of money. It's still very small, but it'd be great for HPQ. So I'm still going to only go 12, even though the historical average for companies is 15. But I still want to be conservative, and hopefully the stock falls underneath those conservative numbers. Now, the final numbers. What are my desired annual returns? So guys, I don't want to double dip here. Desired annual return is what you want to make on the company. You can invest in an ETF and get 9 or 10%. So this should be a higher number than that. It should also be a number that gives you ample margin of safety. On some big companies that I know very well, like Google, Microsoft, things like that, Apple, I only want 12.5% return. But as the companies are dying or have issues, I want a higher return. And as my assumptions get higher, I probably put a higher return in. So watch what I'm going to do here. I'm going to do 12.5. I'm going to do 12, 15, and 18%. Because these assumptions are very high, I want a bigger margin of safety of that actually happening. I want to have bigger gap between price and value. As these companies are really low, I'm okay with a lower return because these are still really bad. So even though I got these, I'm okay with that. That's still a pretty good return on these companies. So the stock's currently at 29 bucks. I'm going to hit the analyze button. Pump the brakes real quick. When I hit the analyze button, 6 numbers are going to pop up. Low, middle, and high value for earnings multiple, and low, middle, and high value for a free cash flow multiple. If it's all green, don't go rush out there and buy. You need to make sure that all of these assumptions are correct. And the most common question I get, Paul, how do I verify they're correct? There's a thing called scuttlebutt. Go out there and see what people are saying. Guys, easiest way, join our community. This community was specifically created where thousands of people every single day are talking about investments. I guarantee HPQ is discussed because Warren Buffett had it and it's down a lot today. Go find out what people have researched. We have access to our 10K in there. I guarantee some investors in here have researched it. Guys, researching is not fun. So use the power of people. We created this because being a value investor is a very lonely road. When I started being a value investor 15, 20 years ago, there was nobody around me. I did it on my own. As time went on, I added a few people. Now we created this community and we have thousands of people in there. And this is all available for less than a cup of coffee per day. It is a no-brainer. If you can make 1 or 2% a year or avoid 1 or 2% of losses a year, it will mean the difference between millions of dollars or hundreds of thousands of dollars in your lifetime. And let's just look at the comparison. This is what our software does. It has a mobile app, 8 pillars, 30 years of financial data, stock analyzer tool, exclusive daily content just for you, access to Seth, Mo, and I, real estate calculator, stock screeners, retirement calculator, and this big EM community chat. $29 a month, less than a cup of coffee per day. These are competitors. They don't even offer this, and they're way more money, including Yahoo Finance. Guys, this is a no-brainer. If you're serious about investing, jump on it. So let's go here real quick. I hit the analyze button. All right, guys. Low side, low 20s. High side, high 30s, low 40s. Middle side is 32 with ample margin of safety. So if you want to keep track of this thing, add it to your watch list on our software. Maybe when it hits 2750. But guys, thanks very much for watching our video. To learn more about our margin of safety and what I believe in it, go watch our next video about margin of safety, and please subscribe to our channel. Thank you very much.